Welcome back to the deep dive. Today, we are putting on our hard hats, I guess, and plunging into what might be one of the trickiest financial zones for global entrepreneurs. We're talking U.S. tax obligations for non-resident e-commerce sellers. So if you're running a business on, say, Amazon from outside the U.S., this deep dive is definitely for you.
Yeah, it's less a blueprint, maybe more like a survival guide, because the rules are, well, they're vast, and the stakes incredibly high. Our mission today is really to systematically unpack these U.S. tax obligations for foreign persons, non-residents, right, who are engaged in systematic, continuous trade on U.S. marketplaces. Think Amazon.
Okay, systematic trade, not just the odd sale here and there.
Exactly. We're not talking about isolated, one-off sales. We're focused on activity that pretty clearly rises to the level of a U.S. trade or business, USTB, for sure.
Right, USDB. So we're setting the scope high,
Yep.
systematic trade. But maybe before we jump into the four pillars of taxation you mentioned,
Yeah.
let's just quickly clarify who we mean by non-resident for you listening. This definition is kind of the starting line, isn't it?
Precisely, yeah. We're assuming the seller doesn't meet the substantial presence test for U.S. tax residency. Now, that's a complex calculation in itself, involving days spent in the U.S.
Like the 183-day rule, roughly.
Generally, yeah.
Yeah.
Over a rolling 3-year weighted period. If you haven't spent enough time physically in the U.S., you're likely a non-resident for tax purposes. If you do pass that test, well, then you're taxed basically like a U.S. citizen, and honestly, these specific rules we're discussing today don't really apply in the same way. And also, importantly, our discussion here, it primarily focuses on situations where maybe the seller's home country doesn't have a solid tax treaty with the U.S., or maybe there is a treaty, but it doesn't offer protection for some reason.
Okay. Which brings us to something you flagged earlier, this critical technicality about how U.S. law interacts with those international treaties.
Yeah.
Can often void planning, you said.
Oh, absolutely. This is where history, the timing of laws, really matters. We have to highlight the critical later-in-time rule, sometimes called the last-in-time rule. It's a fundamental principle in U.S. tax law. Basically, if an act of internal U.S. legislation, like a section of the Internal Revenue Code, the IRC, was enacted after a tax treaty was signed, well, the U.S. law takes precedence.
Okay, hold on. Let's make that concrete. Say, my country, hypothetical country, signed a treaty with the U.S. back in 1990. And it says, my e-commerce profits are only taxed back home. But then Congress sees the digital boom and in 2025 passes a new law saying, nope, inventory stored in the U.S. creates a permanent establishment taxable here. What happens then?
The 2025 domestic law wins. Simple as that. The U.S. Supreme Court has confirmed this multiple times. What it means for you, the seller, is you have to constantly monitor both U.S. domestic law and your treaty provisions. Because a new U.S. law can effectively switch off an old treaty benefit overnight, you absolutely have to track the chronology. Which law came last?
Wow. Okay, that's a huge technical burden right from the start. So keeping that shifting legal ground in mind, let's introduce these four main taxes every non-resident seller needs to think about when selling into the U.S.
Right. We call them the 4 pillars of U.S. taxation for foreign sellers. It's a good way to frame it. First, there's the federal income tax. That's kind of the big one, the foundation. Applies to corporations worldwide and U.S.-sourced income for non-residents. Second, state income tax. This is where it gets really complicated. Think 50-plus jurisdictions, each with its own rules. The complexity multiplier, as you said. Third, sales tax. This is a consumption tax paid by the buyer, but managed by the seller across, get this, over 10,000 different local entities, states, counties, cities.
10,000. Wow.
Yeah, it's staggering. And fourth, franchise tax. This one's a bit different. It's a tax on the privilege of doing business in a state, sometimes regardless of profit, usually levied by states.
Okay, 4 pillars: federal income, state income, sales tax, franchise tax. And as you noted, while they're all critical, the biggest financial weight, the starting point for everything else, it often seems to be pillar 1, the federal income tax. So let's unpack that federal standard first.
Sounds good. To trigger federal tax jurisdiction, first we need what's called nexus. Basically, a strong enough connection between you, the taxpayer, and the U.S. government.
And there are 2 main types of connection, right? Political, like being a resident.
Correct. That's group 1, tax residency or U.S. domicile status. But for our non-resident seller, the relevant connection is usually group 2, the economic connection. This means you're carrying out an activity in the U.S. that's substantial enough, consistent enough, to allow the U.S. government to tax the profit you make from it.
And that standard, that substantial activity, is defined by those 3 letters we mentioned earlier. USTB. What actually constitutes a U.S. trade or business?
Well, the IRS guidance is pretty broad, honestly. If a foreign person owns and operates a business in the U.S., selling services, products, merchandise, that generally counts as USTB. And specifically for e-commerce, the profit you make from selling inventory property in the U.S., and this is key, it doesn't matter where you bought that inventory initially, that profit is usually termed effectively connected income, ECI.
Okay, ECI, effectively connected income.
Yeah.
But what's the clear dividing line? How do you distinguish USTB from just, a sporadic sale?
Yeah, good question. The key standard the phrase the IRS uses is that the business activity must be considerable, continuous, and regular. So if you're systematically using Amazon FBA, right, storing inventory in U.S. warehouses, fulfilling orders month after month, well, that's pretty clearly considerable, continuous, and regular. That kind of activity almost certainly meets the USTD threshold.
Okay, and this is where you mentioned something really interesting earlier about sourcing rules. If you have USTB, it can override the normal rule about where title transfers. Can you walk us through why that's so important?
Right. So typically, income sourcing depends on where the title, the legal ownership of the goods, passes from seller to buyer. If your contract says title transfers in, say, Mexico normally, that income should be Mexican sourced. However, if your overall activity rises to the level of USTB because you have this ongoing business operation within the U.S., using U.S. warehouses, U.S. marketplaces, the IRS effectively says, doesn't matter where the paper says title transferred. That income is considered American sourced because the economic substance of the activity is here. It prevents sellers from using a simple legal trick, like changing the title transfer location on paper, to avoid U.S. tax while still heavily relying on the U.S. market and infrastructure.
Got it. So establish USTB, and boom, the profit is generally U.S.-sourced ECI.
Yeah.
You also mentioned income could come from 3 sources for non-residents. Can you clarify that quickly?
Yeah, technically there are 3 ways. Source 1 is just general income from sources inside the U.S. as defined by the tax code, Section 861. Source 2 is the ECI we've been talking about, income from the trade or business actually conducted in the U.S. And then there's Source 3, which can be a bit confusing. It's ECI from sources outside the U.S., but only if that foreign income is still demonstrably and effectively connected to the USTB you're conducting inside the U.S., like maybe using your U.S. base to facilitate certain foreign sales. It can get complicated.
Okay. Let's pivot now to the individual seller. They've determined they have ECI. They need to file that Form 1040-NR. How is their actual taxable income calculated? Is it like a level playing field compared to a U.S. resident?
In terms of calculating the business profit, it's actually very similar. You take your gross ECI, you subtract your allowable business expenses directly related to generating that ECI, and you arrive at your net profit. That net profit is then taxed at the same progressive rates as a U.S. resident's income. The one significant difference, theoretically, is that your foreign income that's not related to the USTB is generally exempt from U.S. tax. The U.S. is only aiming to tax the profit directly tied to your U.S. business activities.
Okay, that sounds reasonable on the surface. But now we get to what you call the financial gut punch, the limitations on deductions for non-residents. This sounds like the key takeaway for someone listening.
It is absolutely critical. The restrictions are severe, and they can be financially devastating if you're not ready. First and foremost, non-residents filing the 1040-NR absolutely cannot claim the standard deduction. Let's just pause on that.
Okay, no standard deduction. What does that mean in dollars?
Well, for 2025, just as an example, a single U.S. resident gets to knock off roughly $15,000 from their taxable income right off the bat. No questions asked. Our non-resident seller, they lose that entire benefit. Poof, gone. They start paying tax $15,000 higher up the income scale than their U.S. counterpart doing the exact same business. This makes documenting every single legitimate business expense absolutely non-negotiable. It's your only way to reduce that taxable income.
Wow. Okay, $15K gone. What else is off the table deduction-wise?
Most other personal non-business deductions are also disallowed. Things U.S. residents often rely on. Think mortgage interest on a personal home, state and local taxes, self-stelt.
Yeah.
If they aren't directly related to the ECI, medical expenses, gone. And structurally, their filing options are limited too. Generally, they have to file as single or married filing separately. They can't use the more advantageous statuses like head of household or, crucially, married filing jointly unless they make a special, often complex election to treat their non-resident spouse as a U.S. resident for tax purposes, which has its own implications.
So the pressure to meticulously track and deduct those ordinary and necessary business expenses under Section 162A, related only to the U.S. business, becomes absolutely paramount because there's no standard deduction safety net.
Precisely. That's the game. You have to prove the expense was ordinary typical for your kind of business, and necessary meaning it helped generate that ECI. Keep every receipt, every invoice. Documentation is everything.
Okay. This brings us back to the marketplace itself. Amazon, for example. They need to know how to handle the payments they're sending you, right? You mentioned the Form W-8 ECI as being essential. Let's spend a moment on why that specific form is so vital.
Right. Form W-8 ECI. It stands for Certificate of Foreign Person's Claim that income is effectively connected with the conduct of a trade or business in the United States. It's a mouthful. But if you're systematically selling inventory generating ACI, you must file this form with the marketplace, with Amazon. It's your instruction to them. It says, hey, this income is ECI. Please do not apply the default withholding tax to the gross amount.
And why is that instruction so critical? What happens if you don't file the W-8 ECI or file the wrong form?
If Amazon doesn't have a valid W-8 ECI on file for you, they have to assume the income is something else. They default to treating it as FDAP income that's fixed, determinable, annual, or periodic. Think passive income, like dividends, some interest, royalties. And the rule for FDAP income paid to foreign persons. It's subject to a flat 30% withholding tax taken right off the gross payment.
Wait, hang on. 30% of the gross, so if my total sales are $100,000, but my actual profit after costs is only, say, $10,000, Amazon would withhold $30,000 and send it to the IRS. I'd actually lose money on the whole operation.
Exactly. You've just paid tax on your costs on money that wasn't even profit. It's a potential financial disaster. By filing the W-8 ECI correctly, you stop that. You're certifying this isn't passive FDAP, this is active business income, ECI, and it should be taxed on a net basis after my expenses at the regular progressive rates. People often mistakenly file Form W-8-BEN or W-8-BEN-E. Those are for the passive FDAP income we just talked about, or for entities claiming treaty benefits on that passive income. For active trade or business income, W-8 ECI is your lifeline. Form AT33 is only for personal services, and W-9 is only for U.S. persons. So W-8 ECI is the one.
Okay, that distinction is incredibly important. W-8 ECI for active business income. Got it. That clarity really helps frame the next big decision structure. Do you operate as an individual filing that restrictive 1040 NR, or do you use some kind of entity like an LLC, a corporation, maybe even a foreign one?
Yeah, the entity choice is huge, and it's complicated because how a business is set up legally in its home country or even in the U.S. often doesn't match how the IRS taxes it. The IRS cares about the tax classification, not the legal name. And broadly speaking, there are three main tax classifications for commercial organizations that sellers might use.
Okay, classification 1, the disregarded entity. Sounds invisible.
Pretty much for tax purposes. Typically, this is a single-member LLC. The IRS basically looks right through it and taxes the income directly to the owner. So if you're a non-resident owner of a single-member U.S. LLC engaged in USTB, the income flows directly onto your individual Form 1040 NR, taxed once at your individual level. Simple, but offers less liability protection.
Right. Classification 2, the pass-through entity.
This usually means a partnership, or maybe a multi-member LLC, that hasn't chosen to be taxed as a corporation. Like the name suggests, the income passes through the entity to the partners or members. The entity itself generally doesn't pay federal income tax. The owners pay it on their share of the profits, again, usually on their individual returns. But this leads to a really critical rule you need to know. If a non-resident individual is a partner in any partnership, could be a U.S. one, could be a foreign one, and that partnership itself is engaged in USTB, then that individual partner is automatically considered engaged in USTB too.
Whoa, automatically. So just being a partner drags you into the U.S. tax system if the partnership is doing business here. There's no separation.
None whatsoever for USTB determination. It's instantaneous and automatic. The activity of the partnership is attributed directly to the partners for that purpose. Very important distinction.
Okay. And classification 3, the subchapter C corporation, the classic corporate structure.
Yep. The C Corp. This is the most distinct structure legally and for tax. It's a separate taxpayer from its owners, but it comes with that famous, often criticized two-tier or double taxation system.
Right, double taxation. Let's break down exactly how that works for our non-resident e-commerce seller using a U.S. C Corp.
Okay, level 1 happens inside the corporation. The C Corp calculates its net profit just like any business, and then it pays corporate income tax on that profit. Currently, that's a flat federal rate of 21%, mandatory.
21% off the top, paid by the corporation itself. Then what?
Then, level 2 happens if and when the corporation distributes its remaining after-tax profits to its shareholders as dividends. For a non-resident shareholder receiving those dividends, that dividend income is generally considered FDAP income. Remember that from the W08 discussion.
FDAP, yes. Fixed, determinable, annual, periodic.
Exactly. And that FDAP dividend income paid to a non-resident is typically subject to that flat 30% withholding tax taken right out of the dividend payment. Now, a tax treaty between the U.S. and the shareholder's home country might reduce that 30% rate, often to 15% or even lower, but the default is 30%. So you see the two layers, 21% tax paid by the court, then potentially up to 30% tax paid by the shareholder on what's left when it's paid out, hence double tax.
Okay. Now, what if the seller decides to use their foreign corporation, say their existing company back home, to conduct the USTB in the U.S., maybe through FBA? Do they escape that second layer?
Not necessarily. They face a very similar two-tier structure, but the second layer has a different name, the branch profit tax, or BPT.
Branch profit tax. Okay, how does that work?
So if a foreign corporation is directly engaged in USTB in the U.S., the IRS basically treats that U.S. operation as a branch of the foreign company. Level 1 is identical to a U.S. C Corp. The foreign corp pays the flat 21% U.S. corporate income tax on its ECI, the profit generated by that U.S. branch activity. But then, at level 2, instead of withholding tax on actual dividends paid out later, the U.S. imposes the 30% branch profit tax. This BPT is calculated on the branch's earnings that are deemed to be repatriated, sent back to the foreign head office.
Deemed repatriation. So the U.S. is essentially saying, look, you earned this profit here through your U.S. branch. We assume you're eventually going to take it out of the U.S., so we're going to tax that potential withdrawal now as if it were a dividend.
That's exactly the concept. It's an anti-avoidance measure. It tries to put the U.S. branch of a foreign corporation on a similar footing, tax-wise, to a U.S. subsidiary paying dividends to its foreign parent. That 30% BPT rate can also potentially be reduced or eliminated by a tax treaty, but the treaty has to specifically address the branch profit tax. Not all treaties do or do so favorably.
Okay, so whether it's a U.S. C Corp paying dividends or a foreign corp facing DBT, you're looking at potentially 21% plus maybe 30%. That total tax bite could get really high, possibly over 45% effective rate when you compound it. Given that, why would any non-resident choose a corporate structure over, say, a disregarded LLC?
It seems counterintuitive, right? But it comes down to balancing tax costs against other factors, primarily liability protection. First, a C Corp, whether U.S. or foreign, is a separate legal entity. Its debts are its own, not the owner's personal debts. If you're selling a product with potentially high liability risk, maybe electronics, children's toys, supplements, that corporate shield separating your personal assets from business lawsuits can be invaluable, worth the potential tax cost. A disregarded LLC generally doesn't offer that same robust separation. Second, the double tax on C Corp isn't always immediate. The corporation doesn't have to distribute all its profits as dividends every year. Profits can be retained and reinvested in the business, deferring that second layer of tax. Or profits might be extracted through other means, like salaries or loan repayments to the owner, if properly structured, which might be taxed differently.
Okay, so liability shield and potential tax defer. Makes sense for certain businesses.
No.
One last point on foreign entities. How does the IRS decide if my foreign company, maybe my UK limited company or German GmbH, is treated as a C Corp for U.S. tax purposes versus a partnership pass-through?
It usually hinges on liability. The IRS regulations have default classifications. Generally, a foreign entity is classified as an association, which means it's taxed as a C Corp if all of its members or shareholders have limited liability for the entity's debts. Think of a typical corporation structure. If even one member or partner has unlimited personal liability for the entity's debts, then the entity usually defaults to being classified as a pass-through entity of partnership for U.S. tax purposes. So that limited liability feature is the key determinant for corporate classification of foreign entities.
Got it. Liability is the key. Okay, we've laid the federal groundwork, which is complex enough, but now we need to transition from the, relatively consistent single federal system to what you call the complexity multiplier, state income tax. We're not just dealing with the IRS anymore. We're potentially dealing with 50 states plus D.C. plus territories, each with its own income tax system, its own nexus rules, deadlines. It sounds like a nightmare.
It honestly can be. This is where compliance often becomes truly exhausting for online sellers. State income tax, just like federal, only applies if the seller has a strong enough connection or nexus to that specific state. But the biggest headache, the thing that trips up so many non-residents, is the interaction or lack thereof with international tax treaties.
Right, you mentioned this earlier, and it's worth repeating because it's so counterintuitive. U.S. international tax treaties, the ones negotiated by the federal government, are generally not binding on the individual state governments. Is that right?
That's absolutely correct. It shocks many people. So how do states handle this? They generally fall into three camps. Camp 1. Some states offer direct recognition. They basically say, okay, we'll respect the federal treaty benefit. These are becoming rarer. Camp 2. More common is indirect recognition. Here, the state calculates its tax based on your federal taxable income figure, maybe your adjusted gross income, AGI. If a federal treaty already reduced your federal AGI, then that benefit indirectly flows through to reduce your state tax base too. Camp 3. And then you have the most aggressive states, which practice direct denial. They explicitly say, we don't care about U.S. international treaties. If you have nexus here and earned income sourced here according to our rules, you owe us tax, even if a treaty exempts you from federal tax.
Wow. So a treaty might protect you from the IRS, but leave you exposed to California or New York.
Potentially, yes. It depends on the specific state's approach. Now, how do you get nexus in a state for income tax purposes? There are two main ways, similar to federal but with state-specific twists. Physical nexus and economic nexus.
Okay, let's take our hypothetical seller, Alex, based in Germany using Amazon FBA. Alex just shipped their first big batch of inventory to the U.S. Amazon receives it. What just happened regarding state income tax nexus?
Alex almost certainly just established physical nexus in multiple states.
Right.
This is the huge tripwire for FBA sellers. Physical nexus for state income tax is triggered by having a physical presence. That can be an office, employees, rented equipment, or, crucially for e-commerce, storage of inventory in a fulfillment center like Amazon FBA. State tax authorities and courts have been very clear on this. Storing your inventory in a third-party warehouse within a state practically always creates physical presence and establishes substantial nexus for state income tax purposes. It doesn't matter that Alex manages it remotely from Germany.
So Alex's 100 boxes of artisanal German cuckoo clocks, which Amazon decides to spread across warehouses in, say, California, Texas, and New Jersey. Alex now potentially has an income tax filing obligation in California and New Jersey just because the inventory is sitting there. Texas has no corporate income tax. Lucky break there, maybe.
That's the reality. Alex now needs to understand the income tax rules, specifically for California and New Jersey, and potentially other states where Amazon might move that inventory later. It's triggered by the physical location of the goods. The second way is economic nexus. This is based purely on the volume of sales or transactions Alex makes into a particular state, even without any physical presence there. If Alex sells, say, over $500,000 worth of clocks into Illinois in a year, Illinois might say Alex has economic nexus and owes Illinois income tax on the profits from those sales, even if no clocks were ever stored there. These thresholds vary significantly by state.
Okay, so physical nexus from FBA is almost guaranteed. Economic nexus depends on sales volume per state. Is there any small relief geographically, like states without income tax?
Yes, that's the only silver lining sometimes. Alex got lucky with Texas in our example, as it doesn't have a corporate income tax, though it has a margin tax, which is similar. Several states lack a broad individual income tax, like Florida, Nevada, Washington, Wyoming, South Dakota, Alaska, Tennessee. And some lack a corporate income tax, like Nevada, Ohio, Texas, Washington, Wyoming, South Dakota. Ohio and Texas have gross receipts taxes instead, though.
But just because a state like Florida has no income tax doesn't mean Alex is totally off the hook there, right?
Yeah.
Other taxes might apply, or they might still need to file something.
Absolutely. Critical point. No income tax doesn't mean no tax burden. Florida has sales tax, potentially other fees. Plus, having nexus in Florida, due to inventory, could still impact Alex's tax situation in other states, or even back home in Germany if there are double taxation issues. You can't just ignore states without income tax. And beyond the tax itself, the administrative burden of just filing the returns can be significant, sometimes more costly than the tax owed, especially if the income per state is small.
Right, and the filing requirements themselves vary wildly, too.
Astonishingly so. Alex might face really strict states, like maybe Arkansas or Delaware historically, which could require filing a return for any income source to the state, even a tiny amount. Then you have states with specific filing thresholds like Alabama or Hawaii, where you only need to file if your state-sourced income exceeds, say, $1,000 or some other small amount. Some states offer de minimis exceptions, like maybe Georgia or Idaho, exempting filing if the income is truly minimal. And less relevant for pure e-commerce, but some states have day count thresholds for people physically working there. File only if you worked more than X days in the state, like Indiana or Montana. Alex has to navigate this patchwork quilt for every state where they might have nexus.
Patchwork quilt is a good description. Okay, moving from the complexity of 50-plus state income tax systems, Let's talk about the sheer scale of sales tax. You said 10,000 jurisdictions. How is that even possible?
It sounds unbelievable, but it's true. Sales tax in the U.S. isn't just a state-level tax. States authorize counties, cities, and sometimes even special districts, like transit authorities, to levy their own sales taxes on top of the state rate. So a single sale could be subject to a state rate, a county rate, and a city rate all added together. And these rates and the rules about what's taxable can change frequently. Managing compliance across 10,000 potential taxing jurisdictions, it's a monumental task, especially without automation.
Before we get into nexus for sales tax, let's quickly clarify for listeners maybe used to VAT or GST systems elsewhere, how is U.S. sales tax fundamentally different?
Good point. U.S. sales tax is a consumption tax, meaning it's designed to be paid by the final consumer. It's typically applied only once at the point of the final retail sale. This differs from VATGC, which is usually a multi-stage tax applied at each step of the supply chain, manufacturer to wholesaler, wholesaler to retailer, retailer to consumer, with businesses getting credits for the VAT they paid on their inputs. Because U.S. sales tax hits only the final sale, businesses buying goods for resale, like Alex buying inventory, generally don't pay sales tax on those purchases. They provide their supplier with a tax exemption certificate or resale certificate to prove the goods are for resale.
Okay, single stage tax, paid by the buyer, collected by the seller. Got it.
Yeah.
Now, nexus for sales tax. This landscape was dramatically changed by a Supreme Court case a few years ago, wasn't it? South Dakota v. Wayfair.
Absolutely. The 2018 Wayfair decision revolutionized sales tax nexus. Before Wayfair, states generally needed a seller to have a physical presence in the state to require them to collect sales tax. Wayfair threw that out for remote sellers. So now we generally talk about four main types of nexus for sales tax. First, physical nexus. This is the old standard and it still applies. Having a store, office, employees, or crucially for Alex inventory stored in an FBA warehouse in a state creates physical nexus for sales tax, just like for income tax.
So FBA triggers physical nexus for both income and sales tax in the state where the inventory is.
Generally, yes, it's a double whammy. Second, economic nexus. This is the Wayfair standard. Even with no physical presence, Alex can establish sales tax nexus in a state simply by exceeding that state's threshold for economic activity. This is usually defined as a certain amount of sales revenue into the state, commonly $100,000 per year, or a certain number of separate transactions into the state, often 200 per year. If Alex hits either of those thresholds in a state like Kansas, even if they have no inventory stored there, they now have economic nexus and must register to collect Kansas sales tax.
Wow, $100,000 or 200 sales. It's not a huge threshold for a successful online business. Okay, what are the other two types?
Third is affiliate nexus. This can be triggered if Alex has a relationship with another business that does have a physical presence in the state. Maybe they share branding, have common owners, or one refers customers to the other in a structured way. The in-state affiliate's presence can create nexus for Alex. And fourth is click-through nexus. This is similar, but usually involves paying commissions to an in-state resident or company, like a website affiliate or blogger, for referring customers who click through a link on their site and make a purchase from Alex. That commission-based referral relationship can create nexus in some states.
Okay, it's a lot of ways to trigger nexus. Physical, economic, affiliate, click-through. Now, you said the buyer is the taxpayer, but the seller acts as the agent. What exactly is the seller's duty here?
The seller's duty is substantial. If they have nexus in a jurisdiction, they are legally obligated to 1. Calculate the correct combined sales tax rate for the specific delivery address, state plus county plus city plus special district. 2. Collect that calculated tax from the buyer at the time of sale. And 3. Remit that collected tax to the proper state or local tax authority by the required deadline, usually monthly or quarterly. It's a significant administrative burden, which is why automation is key.
Right. And this is where the marketplace facilitator laws come in, correct? Platforms like Amazon often handle this now.
Yes, thankfully for sellers. Most states now have marketplace facilitator laws. These laws shift the legal obligation to calculate, collect, and remit sales tax away from the individual third-party seller, like Alex, and onto the marketplace platform itself, like Amazon, eBay, Etsy. So in states with these laws, Amazon is generally responsible for handling the sales tax on Alex's sales made through their platform.
That sounds like a huge relief. So if Amazon is handling it, does Alex still need to worry about sales tax nexus?
This is a critical nuance. While the marketplace handles the collection and remittance, the facilitator laws generally do not relieve Alex of the underlying responsibility or the fact that they still have nexus in the state due to FBA inventory or economic activity. Alex might still need to register for a sales tax permit in some states, even if Amazon is collecting, just to report exempt sales or for other compliance reasons. And, importantly, if Amazon makes a mistake, or if Alex provided incorrect information about the taxability of their product, the state could potentially still come after Alex. The ultimate liability doesn't vanish entirely. Alex still needs to understand the rules.
Okay, so facilitator laws help immensely with the doing, but not necessarily with the underlying obligation or nexus. Good distinction. What about exemptions? When might a sale not be subject to sales tax?
Exemptions are common, but require careful documentation. Sales might be exempt based on the buyer status, for example. If Alex sells inventory B2B to another reseller who will sell it again, that reseller must provide Alex or Amazon with a valid exemption certificate or resale certificate for that state. Without that certificate on file, Alex or Amazon must charge tax. Other exempt buyers might include governments, schools, or charities. Or sales might be exempt based on the type of product. Some states exempt groceries, prescription drugs, certain clothing, or maybe, say, equipment used in manufacturing. And sometimes sales to buyers who are non-residents of the state might be exempt under specific conditions. Each state has its own rules.
And managing those exemption certificates sounds like another administrative task. Finally, compliance headaches. You mentioned states are aggressive. What happens when Alex crosses one of those economic nexus thresholds, like the $100,000 or 200 transactions?
Yeah, states can be incredibly aggressive here. Once Alex crosses an economic nexus threshold in a state, the clock starts ticking immediately. Some states expect registration and collection to begin on the very next transaction or within a very short time frame, sometimes just days. There's often very little grace period. Failure to register and collect timely can lead to assessments for uncollected tax, plus significant penalties and interest, going back to when nexus was triggered. And another complexity. States sometimes have different economic nexus thresholds or rules for marketplace sellers who use FBA and likely have physical nexus anyway, versus pure remote sellers who only sell direct to consumer from abroad with no U.S. inventory. You have to know which category you fall into for each state's rules.
Constant monitoring seems essential. Okay, let's move to the fourth and final pillar, franchise tax. You described this as a tax on the privilege to operate. Sounds a bit archaic.
It kind of is. Franchise tax is a state-level fee charged simply for the privilege of existing as a legal entity, like a corporation or LLC registered in that state, or for the privilege of doing business there. It's currently collected in about 14 states, and critically, it's often levied regardless of whether the company is profitable or sometimes even regardless of whether it's actively trading. Many experts do view it as a bit of an anachronism likely to fade over time, but for now, it's a real cost in those states.
And what's the tax actually based on, if not profit?
It varies wildly by state. It could be just a flat annual fee, or it could be based on the company's net worth or capital stock, basically assets minus liabilities. Or sometimes it's based on gross receipts or revenue generated in the state. Or, confusingly, some states do base it on profit, making it very similar to a corporate income tax. The taxpayers are usually subchapter sue corporations, but some states apply it to pass-through entities like LLCs and partnerships too. Rates are generally low, maybe 0.02% in Wyoming, up to maybe 0.3% in Arkansas on the relevant base. But the key factor is whether there's a maximum cap. 6 states cap the tax, 8 don't, leaving potential for a large bill if the base, like net worth, is high.
Okay. Since Delaware is such a popular state for incorporating, especially for foreign entrepreneurs, let's use it as a case study. How does Alex navigate Delaware franchise tax if they set up a Delaware entity?
Right, Delaware is common, so it's a good example. The rules differ significantly between corporations and LLC SLPs. For Delaware corporations, the total annual cost is a $50 annual report filing fee plus the actual franchise tax due. And crucially, the corporation gets to choose between 2 different methods to calculate the tax, and they pay the lower of the 2 results.
Okay, 2 calculation methods for corporations. What's method 1?
Method 1 is the default, the authorized shares method. It's based purely on the number of shares the corporation is authorized to issue in its formation documents, regardless of how many are actually issued or outstanding. The tax starts low, maybe $175 for up to 5,000 authorized shares, but it increases progressively and can reach a maximum of $200,000 per year if the company authorized a huge number of shares. So if Alex just arbitrarily authorized, say, 10 million shares thinking it sounded good, this method could result in a surprisingly high tax bill, even for a small company.
Oh, okay. What's method 2?
Method 2 is the assumed par value capital method. This one is much more complex to calculate. It involves using the company's total gross assets, often taken from a balance sheet, like Schedule L on the Federal Form 1120, and the number of issued shares to determine an assumed par value, which then feeds into the tax calculation. While complicated, this method often results in the minimum possible franchise tax, which is currently $400 plus that $50 annual report fee, so $450 total minimum. Tax advisors often run both calculations to ensure the corporation pays the lowest amount legally possible.
Right, so corporations need that calculation. What about the simpler entities like Delaware LLCs or limited partnerships, LPs? They're also very popular globally.
For LLCs and LPs, Delaware makes it incredibly simple. It's just a flat, fixed annual tax, currently $300 per year, due by June 1st. That's it. No complex calculations based on shares or assets. No annual report filing required for LLCs LPs either. Just pay the $300 flat tax online. This predictability and simplicity is a major reason why Delaware LLCs are so attractive to foreign founders. $300 flat tax. Much simpler. Okay, we've covered the 4 pillars: federal income, state income, sales, and franchise taxes. Now let's shift to the practicalities of compliance deadlines, crucial forms, and then maybe touch on some planning strategies. Let's start with filing deadlines for the individual non-resident Alex, filing Form 1040-NR.
Right. The general deadline mirrors the U.S. resident deadline, April 15th of the year following the tax year. However, there's a helpful extension if the non-resident does not have any U.S. wage income subject to withholding, which is typical for an e-commerce seller. In that case, they get an automatic extension to file by June 15th. And beyond that, just like residents, they can file Form 4868 to request a further extension, usually pushing the final deadline out to October 15th.
Okay, June 15th is the key automatic date if no wages. What about paying tax during the year? Estimated taxes.
Yes, estimated taxes are often required. If Alex expects to owe at least $1,000 in U.S. tax for the year after accounting for any withholding or credits, and if their expected withholding will be less than certain safe harbor amounts, usually 90% of the current year's tax or 100% of the prior year's tax, then they generally must pay estimated tax throughout the year. And the payment schedule for non-residents with no wage income is a bit unusual. It's compressed into 3 payments, not 4 like residents. The first payment, covering the first half of the estimated tax, is due June 15th. The second payment, 1 quarter, is due September 15th, and the final payment, 1 quarter, is due January 15th of the next year.
Okay, tricky schedule, June, September, January, got it. What about deadlines for a foreign corporation that has ECI and needs to file Form 1120-F?
For a foreign corporation, the general deadline depends on whether it has an office or place of business in the U.S. If it does, the deadline is generally the 15th day of the 4th month after its tax year ends, so April 15th for a calendar year company. If it does not have a U.S. office or fixed place of business, which might be the case for an FBA seller operating remotely, they get an automatic extension to the 15th day of the 6th month after their year end, June 15th for calendar year. Estimated taxes are also required for corporations if they expect their total tax liability after credits to be $500 or more. Those payments are generally due in 4 installments throughout the year on the 15th day of the 4th, 6th, 9th, and 12th months of their tax year.
Okay, deadlines covered. Now let's get to what you flagged earlier as potentially the most dangerous area, information disclosure requirements. You said the penalties here can dwarf the actual tax owed. Which forms are absolutely critical for Alex or Alex's corporation to get right?
There are several, but 2 stand out with particularly severe penalties for noncompliance, especially relevant in the structures we've discussed. The first is Form 5472. The title is long. Information return of a 25% foreign-owned U.S. corporation or a foreign corporation engaged in a U.S. trade or business. This form is required in 2 main situations relevant here. 1, by a U.S. corporation that is 25% or more owned, directly or indirectly, by a foreign person. 2, and this is critical for many FBA sellers, it's also required by a foreign corporation that is itself engaged in a U.S. trade or business, USTB. So if Alex is operating their Amazon business through their German GmbH, and that GmbH is considered engaged in USTB in the U.S., which is likely if using FBA systematically, the German GmbH itself must file Form 5472 with the IRS to report transactions with related parties.
Wow, okay. The foreign company itself has to file a U.S. form. What's the penalty if they miss this or file it incorrectly?
The penalty is massive and non-negotiable. Currently, it starts at $25,000 per required form per year that is not filed or is filed incomplete correctly. It can increase substantially if the failure continues after the IRS notifies the company. The IRS views failure to file 5472 very seriously, essentially as an attempt to hide related party dealings and potentially shift profits improperly. The burden of proof is heavily on the taxpayer to show compliance.
$25,000 penalty just for missing an information form. That's terrifying. Okay, what's the second critical form?
The second one to highlight is Form 926, return by a U.S. transfer of property to a foreign corporation. This form is generally required when a U.S. person, that could be a U.S. citizen, a U.S. resident, a U.S. corporation, a state, or trust, transfers cash or other property to a foreign corporation in certain types of transactions, often related to organizing or capitalizing the foreign entity. So, for instance, if Alex, a non-resident, first sets up a U.S. LLC, which might be treated as a U.S. person if it makes certain elections or has U.S. owners, and that LLC then transfers funds or assets to capitalize Alex's foreign operating company, Form 926 might be required from the U.S. LLC. Penalties for failing to file Form 926 can also be severe, potentially 10% of the fair market value of the property transferred, up to a limit, plus other potential consequences.
Okay, Forms 5472 and 926. High stakes for noncompliance. This really underscores the need for careful planning before launching. If Alex is listening and still in that pre-launch phase, what are the key strategic questions they absolutely must answer?
Yeah, thinking this through upfront is crucial. I'd say there are 4 core strategic questions. 1. Entity necessity and jurisdiction. Do I even need a formal entity, or can I operate as an individual despite the 1040 NR limits? If I need an entity, which type offers the best balance of liability protection for my specific product risk versus tax efficiency and compliance cost? C Corp, disregarded LLC, foreign core. And where should it be formed? Delaware, Wyoming, my home country. 2. Warehouse placement and nexus minimization. Can I influence where my inventory is stored? Can I perhaps limit FBA storage to only 1 or 2 states, ideally states with no income tax or lower sales tax complexity, to consciously minimize my state tax nexus footprint? Or use a 3PL that offers more control? 3. Business fractionalization. This is advanced and needs caution. Is it legitimate and feasible to potentially structure the business across multiple smaller legal entities to stay below certain economic nexus thresholds in various states? Warning, this must have genuine business purpose. Doing this purely for tax avoidance without substance can be deemed illegal tax manipulation by authorities. Get expert advice here. 4. Profit extraction strategy. Assuming the U.S. operation is profitable, how will I legally and tax efficiently get those profits out of the U.S. entity and back to myself or my foreign parent company? Will it be via dividends, triggering withholding or BPT? Can I justify paying salaries or management fees, which might be deductible in the U.S.? Can I use loans and interest payments between related entities, subject to strict rules? Planning this extraction path is vital.
That fourth point, extracting profit via things like management fees or intercompany pricing, leads us directly to the minefield of transfer pricing.
Huh.
Why is this such a heavily scrutinized area by the IRS, especially with international e-commerce structures?
Because it's the classic way multinational businesses, even small ones, can try to shift profits from high-tax countries like the U.S. to lower-tax countries. The risk scenario is simple. Imagine Alex owns both a manufacturing company in country A, low tax, and the U.S. distribution company, a C Corp subject to 21% tax. The manufacturing company A could sell the products to the U.S. company B at an artificially inflated price. The U.S. company B then records a very high cost of goods sold, drastically reducing its taxable profit in the U.S. The profit has effectively been shifted upstream to country A, where it's taxed at a lower rate or maybe not at all.
Right. The U.S. entity shows minimal profit. The foreign entity shows huge profit. So how does the IRS combat this artificial shifting?
They have a very powerful tool. Section 482 of the Internal Revenue Code. This section gives the IRS broad authority to reallocate income, deductions, credits, or allowances between related entities if they determine it's necessary to prevent tax evasion or to clearly reflect the true income of each entity. The core principle under Section 482 is the arm's length standard. This means that the price and terms for any transaction between related parties, like Alex's 2 companies, must be the same as they would have been if the parties were completely independent and unrelated, bargaining at arm's length in the open market.
Okay, the arm's length standard. And the IRS has specific methods they use to determine what that arm's length price should be, right?
Exactly. The regulations under Section 482 outline several approved transfer pricing methods. They generally fall into 2 categories. Traditional transaction methods. These try to find direct comparisons. The most preferred is the comparable uncontrolled price, CUP method basically. Did then the manufacturer sell the exact same product to an unrelated third party? If so, that price is the benchmark. Others include the resale price method, looking at the distributor's gross margin, and the cost plus method, looking at the manufacturer's cost plus a reasonable markup. Transactional profit methods. These are often used when direct comparable transactions are hard to find, which is common. The main ones are the transactional net margin method, TNMM, which compares the net profit margin the U.S. entity earns relative to its costs or sales, against the margins earned by comparable independent companies performing similar functions, like distribution. And the profit split method, used for highly integrated operations where it's hard to separate functions, divides the combined profit based on each entity's relative contribution. Choosing and documenting the appropriate method is complex and critical for defending your transfer pricing.
Complex indeed. Okay, we have covered an immense amount of ground. From the 4 pillars of tax, the intricacies of USTB and ECI, the entity choices, the nightmare of state nexus via FBA, sales tax facilitator rules, franchise taxes, and finally compliance deadlines and the dangers of transfer pricing and information reporting. What really stands out is that contrast, isn't it? The federal system, while strict, especially that loss standard deduction for individuals, is relatively uniform once USTB is established. But it's the patchwork of state rules, where just using FBA can instantly trigger physical presence and filing obligations in numerous unpredictable states. That seems like the biggest ongoing compliance headache.
I absolutely agree. That state-level complexity, particularly the physical nexus created by FBA inventory, combined with the non-recognition of treaties by many states, is the biggest practical hurdle for most non-resident sellers. Understanding those 4 tax pillars, making sure you have that W-8 ECI filed correctly to avoid the disastrous gross withholding, and proactively anticipating where your inventory might create physical or economic nexus, those are really the baseline essentials for survival in the U.S. market.
So after diving deep into USTB, BPT, Wayfair, Form 5472 penalties in the maze of 10,000 sales tax jurisdictions, if you had to leave our listener, the non-resident seller trying to navigate all this, with just one single final provocative thought to mull over, what would it be?
You know, it's interesting. So much focus, understandably, goes into minimizing that headline corporate tax rate, the 21%, or maximizing deductions, or finding the perfect treaty benefit. We obsess over the rate. But when you really look at where foreign sellers get into catastrophic trouble, where the penalties are disproportionately huge, it's often not the tax itself, but the failure to disclose information. Considering the potentially crippling penalties we discussed for things like Form 54722 or Form 926 penalties that can reach $25,000 or more per form per year just for missing paperwork, maybe the ultimate strategy isn't just about aggressive rate optimization. Perhaps the most financially sound, risk-averse strategy for a foreign seller entering the U.S. market is actually to prioritize meticulous disclosure and structural transparency above all else. In the complex, penalty-heavy world of U.S. international tax compliance, maybe being radically transparent isn't just the right thing to do ethically. Maybe it's actually the cheapest, safest decision you can make financially in the long run. Focus on getting the disclosure right, and the rest, while still challenging, becomes far more manageable.